Today, I want to show you how to go from complete investment beginner all the way to getting onto a broker and buying your first share. My name's Paul and I've been creating investment videos here on YouTube for a number of years now. One of the most common questions I get every day is, hey Paul, I've got £1,000, I want to invest it, where should I put it? And instead of me every single time having to explain the same thing over and over again, I've decided to create this video just so I can send this link to people and save all of us a lot of time. This video is designed to get you dipping your toes into the stock market by suggesting what you might want to buy and where you can buy it. But please remember, I am not a financial advisor and there is always a risk of loss in the stock market. Once you've mastered these simple investing steps, you can keep going on this defined path that I'm going to set out for you, or you can learn more about different parts of investing such as pensions, individual stocks, and anything else that might suit your personal goals. But let's slow down and keep it as simple as we can. By the way, a lot of time and effort goes into these videos, so if you like it and it helps you get started, please feel free to like and subscribe. Basic investing is really simple and you can make a lot of money just by following 3 simple rules.
What? Oh, tell me, Maria. Tell me now!
1. Invest in as many things as possible. 2. Continually invest in those things for as long as possible. And 3. Keep taxes and fees as small as possible. So the first rule is, how do I invest in as many things as possible? While you can be very specific and buy individual companies in the stock market, that's often a lot of effort and can often lead to long periods of despair, sadness, and even money loss.
I've got nothing left!
For the vast majority of investors, it's best to buy everything. The easiest and probably safest way to do this is through an index fund. An index is simply a list of companies that all share a common interest. An index fund is something you can buy to track the share price of all those companies. Take this box of celebrations that I've got left over from Christmas. It's a miracle I haven't destroyed it yet. Each one is an individual company that you can buy on the market. But if you get them out at a party, you have no idea which one's going to be the most popular. Even bounties. No one likes bounties, but every year there's a chance that some psychopath is going to come round and start gobbling them all up. This is the same with stocks or individual companies. Each year you have no idea which company is going to do better than another, or which companies are going to go bankrupt. Some say it's impossible. I just get to eat chocolate in this one. But one thing we do know is that everybody likes celebrations. And this whole pack is what we would call an index. An index is a big pack of celebrations that Mars know is going to fly off the shelves every Christmas. No betting on Maltesers or Mars, just sell the lot and you know you'll do well. Buying an index fund is exactly the same. No one knows which companies are going to do well and which are going to do badly, so buy the lot and you should do well on average. If you believe that the entire world is going to be a better place over the next 30 years, then you're likely to make a lot of money. If you don't think the world's going to be better, then there's probably no reason for money at all. You're better off just going out buying a shotgun and a bunker.
Not too bad for a fat guy.
Popular indexes have crazy names that you've definitely heard of, but probably not realised till right now what they actually are.
It's where the FTSE 100 opened an hour ago. The FTSE has fallen very sharply by 8% at one point, and the FTSE, I can tell you, is now officially in bear market territory.
The S&P 500 is an index or a list of the top 500 companies in America. And the FTSE 100 is an index or a list of the top 100 UK companies. And later in the video, I'll show you how to buy them and essentially own all of the greatest companies in the world in just a couple of clicks. But that second rule of investing is that you've got to make a commitment for a very long period of time. Theoretically, even investing in something as broad as the entire world could go wrong. But it's never happened, and for a bit of colour, I'd like to turn to one of the greatest investors ever.
We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore. And it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776.
That man is Warren Buffett, and the point he's making is that humanity endures wars, disasters, viruses over many centuries, but always comes out on top. During these events, the prices of stocks temporarily goes down, but once the clouds clear, the prices go up. They always have, and it's the people that held onto these stocks and index funds through the bad times that make the most money. Take the S&P 500 for example, the top 500 stocks in America. It's riddled with disastrous human events. Here's the 1987 Black Monday crash, here is the famous collapse of the technology stocks in the dot-com bubble, and even inside there it includes 9/11. Here's the 2008 credit crunch, the US-China trade war, and finally something that happened recently which barely affected our lives at all. I have no idea what that could be. The important thing to remember here is that even if you bought at the peak of these crashes, if you just zoom out, you'll see that the best thing to have done is just hold on and wait. So what would have happened if you had £10,000 in 1980 and just held on to it for 40 years through 6 or 7 crashes? Well, according to a 10% return, you would have had turned that £10,000 into over £500,000. And all you would have had to do is call your broker and forget about it.
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 But we also spoke about this long-term commitment. And if in that time you had just committed £100 a month of your salary to continually deposit into the market, into that index fund, just this very small addition every single month bags you over $1 million. What you're witnessing here is the power of compounding interest, and I'm not going to talk about that too much today because I've discussed it to death in many of my other videos. It's just very important to not deviate from that schedule of £100 a month and just keep depositing. And while it's a wonderful idea to buy at the bottom of all of those dips, that is nearly impossible to do. No one can predict when these human disasters are going to happen. That's mainly the reason why they're disasters. So we need to retrain our mindset into thinking that when the stock market goes down, that's actually a good thing because historically it's gone up again. And when it does go down, we get more and more excited to put more and more money in. Take the most recent crash in March of 2020. If we had continued to buy the all world index all the way down through this crash, we would have made money all the way back up through the recovery. This is the principle of dollar cost averaging. We don't know which stocks to buy, so we just buy them all. In the same way, we don't know where the price is going to be tomorrow, so we just buy it all the time. This is the most effortless and consistent way to make money in the stock market. And we don't have to wait for massive crashes to benefit from this. By looking at the market just on a 5-year or even a 1-year timeline, you can see there are peaks and troughs everywhere. Every time you buy halfway down and at the bottom of those troughs, you make a lot of money, and this multiplies your returns. By committing to a monthly deposit schedule, you can benefit from this micro cost averaging as much as you can from the much bigger moves. So now we know the most effortless and probably the safest way to make money in the stock market. Buy as many stocks as you can through index funds and consistently continue to invest in them for as long as you can. So the next questions are, how do I do it? Which one should I buy? And how do I do it for as cheap as possible? First, you need an investment broker. It's not like you can just go to Tesco and buy the stocks off the shelves. Brokers buy shares on your behalf and keep them safe for you until you want to sell them back. Vanguard is famously one of the largest brokers in the world, and it literally invented index funds. But nothing in life is free, and for the privilege of buying these index funds, you are charged a very, very small fee that's contained inside the calculation of the index fund. The FTSE All World Index is the largest index on the market. If you buy this thing, you buy the share of every mid and large sized company in the world. And again, if you believe that the world is going to be a better place in 30 years, then this is probably the index fund for you to buy. It's not the cheapest index fund on the market, but it's probably the cheapest for the least amount of effort that you can put in. And naturally you'd think, well, if I'm going to buy a Vanguard index fund, then I should probably just buy it on the Vanguard platform. But Vanguard has a platform fee of 0.15%. This is on top of the fee that's within the index fund, and you'll see this one come out. Vanguard can even sell your stock to pay for it. There are many other brokers out there like Freetrade, Hargreaves Lansdown and AJ Bell, but they all have a very similar platform fee that will eat into your profits. The investment platform that I use is called Trading212. This is a largely commission-free platform, and as far as I can tell, it's the cheapest place to buy Vanguard index funds, even cheaper than Vanguard itself. That's because there's no platform fee, there's no foreign exchange fee, and of course there's no stamp duty when buying funds. The only charge that you'll get is that 0.22% charge that's already included within the fund. And that's the main reason I'm going to show you Trading212 today. It's the one I use and it's the one I've been most comfortable with for the past couple of years. And it's very simple to sign up on your desktop or your phone. Just go to trading212.com, or you can click on a link in the description below. If you sign up through that link, I get a free share and you get a free share to get yourself started as well. I don't see why you wouldn't do that. It's free money. Just go to open account, put in a valid email address and follow their sign up process. They need to do a lot of validation to check that you are you. It's pretty much the same as signing up to a bank, and I'd advise that you give them the exact identification that they ask for to avoid any delays during setup. These are just the same checks that any other broker would have to do. Once you're done with that process, you're in. And I'm using their app right now rather than the desktop, but you can get the same feel as this is my account that I use. I'd advise that you stay away from the CFD platform just now. That's for very advanced users. And for the purpose of this video, I'm going to be using the Trading212 ISA as it's the most tax efficient. But this is my personal account. It already has some money in it and I'm already invested in many individual stocks. This is advanced stuff and it's for later on. But today we just want to find out how we can invest in very simple index funds. So we go for a search by clicking the magnifying glass at the bottom, and at the top here we type VWRL, which is the code name or the ticker for the Vanguard FTSE All World UCTIS ETF. There's a lot of confusing words in there, but basically all you need to know is that that is an index fund and you want to select the one that's on the London Stock Exchange. And what a day to buy the Vanguard FTSE All World. It's down 2%, and remember, we get very excited when stocks drop quite heavily. Trading212 very helpfully puts in the key information document and allows you to see any information that you might want to see regarding this fund. It tells you the risk value of it, how it's typically quite a high risk investment because it is an investment in the stock market. But right now I want to buy one share of the Vanguard FTSE All World Fund. I click buy and I see the number of shares and I click 1. And Trading212 tells me that that will cost me roughly £90.03. I click review order and it tells me exactly what I'm going to be buying, how much it's going to cost me to buy it, any stamp or tax duties, and because it's an index, we don't actually have any stamp or tax duties, and then I click send buy order. And the order is executed and I have now bought one Vanguard FTSE All World ETF at £90.02. We head back out by clicking on the buy button and we'll scroll all the way down, although you'll probably only have one share at the moment, and we'll see that I've got one share of the FTSE All World Vanguard ETF, and I've already started to lose 3 pence on the market. So congratulations, you've taken your first step on a journey to long-term prosperity and wealth. The key thing to do now is to keep depositing and keep buying more and more shares. You can keep adding £100 a month for 40 odd years, but if you're able to increase that deposit amount, maybe to like £1,000 a month, based on that 10% market assumption, it's not going to take you 40 years to get there. It's actually only likely to take you 23 years. So bigger deposits more consistently are what's required to shorten this time frame. And if you want to learn how I'm contributing so much to my ISA and how I filled it in 1 year, then check out this video next.